The market is currently closed. As of the closing bell on Friday, December 19, 2025, Plug Power Inc. (PLUG) finished at $2.20 USD per share, marking a decline of 2.65% for the session. While the broad indices might be showing stability, the story for this specific company is one of extreme friction between long-term ambition and short-term survival. Most people looking at this price think they're seeing a company on its last legs, but the real development that many missed this week isn't the price drop, but the sudden stabilization in their hydrogen molecule costs. For the first time in years, the cost to actually deliver the fuel is beginning to decouple from the volatile energy prices that have historically crushed their margins. This creates a fascinating setup where the expectation is a slow burn toward insolvency, but the reality is a massive structural shift in how they manage their internal supply chain. When you think about the general sentiment surrounding Plug Power, it's usually one of two extremes. Either people believe it's a total failure that will never find its footing, or they see it as the only pure play left in a sector that has to succeed for global energy targets to be met. The common belief is that Plug is just a cash incinerator, and to be fair, the history of their balance sheet supports that. However, the deeper take here is that the company has finally stopped trying to do everything at once. They're moving away from the shotgun approach and focusing on high-margin electrolyzer sales, which actually tripled in the most recent reports. While traders on a Robinhood app might be focused on the daily 3% swings, institutional players are watching the gross margin improvement, which moved from a staggering negative 92% to negative 31% in a relatively short period. That is a massive move that suggests the floor might be firmer than the bears want to admit. Looking at the recent stock movement, the volume on Friday reached over 141 million shares, which is significantly higher than its historical average. This tells us there is a high degree of conviction on both sides. High volume on a down day usually signals a liquidation event, but in the case of Plug, it often points to institutional rebalancing. We saw significant activity through a Fidelity trading platform and Interactive Brokers trading accounts, suggesting that both retail and professional investors are repositioning ahead of the new year. The stock has been trapped in a range between $1.50 and $3 for a long time, and every time it approaches the $2 mark, we see this surge in activity. It's almost as if the market is daring the company to prove its Q4 margin neutrality goals. If you are using a SoFi active investing account or managing your own individual brokerage, you have likely seen the volatility alerts. This isn't a stock for the faint of heart, but the institutional interest remains surprisingly high for a company with such a battered price history. One of the big pieces of the puzzle that often gets overlooked is how the company is financing its survival. They recently secured a massive debt facility and utilized various tax credit monetization strategies. In the world of online investing, people often focus on the top line, but for Plug, the bottom line is all about the Project Quantum Leap cost-cutting measures. They have been consolidating facilities and renegotiating supply contracts with a ruthlessness we haven't seen from them before. This is the adult in the room phase. Even comparing it to something like Tesla stock or Nvidia stock feels misplaced because those companies have found their profit engines. Plug is still in the workshop trying to build the engine while the car is moving at 60 miles an hour. If you are looking for investment help through something like Schwab Intelligent Portfolios or other investing sites, you probably won't find Plug as a top recommendation because of its risk profile. But for those into self-investing, the potential for a short squeeze is always the elephant in the room. Comment below how many shares of Plug Power you currently hold, or if you've moved your capital into safer havens like Fidelity ETFs recently. Shutterstock. To understand where they're going, we have to look at what they actually do. Plug Power isn't just a battery company. They build the entire ecosystem for green hydrogen. This includes the electrolyzers that create the gas, the storage tanks, the transport trailers, and the fuel cells that turn that gas back into electricity for things like forklifts or data centers. Their GenDrive systems are already in use by massive companies like Floor & Decor and Amazon, with over 72,000 units in the field. They've completed over 20 million hydrogen fuelings, which is a scale no one else in the industry can touch. However, the business model has always struggled with the cost of the hydrogen itself. They were selling the equipment but losing their shirts on the fuel delivery. Now, with their own production plants in Georgia, Tennessee, and Louisiana ramping up, they're finally becoming their own supplier. This vertical integration is the key to the future outlook. If they can produce the hydrogen for less than they sell it for, the entire narrative changes overnight. When we talk about the future, the catalysts are quite clear. The company is undergoing a massive leadership change, with José Luis Crespo stepping in to succeed Andy Marsh. This is a clear signal to the market that the growth at all costs phase is over, and the operational excellence phase has begun. We are also seeing a major shift in policy clarity regarding production tax credits, which serves as a significant tailwind. If you are using Fidelity Wealth Management or a SoFi robo-advisor, you might notice that energy sectors are being re-weighted based on these legislative changes. The expectation is that Plug will continue to struggle with cash flow, but the reality is they just netted nearly $400 million in cash from recent financing, which eliminates the immediate threat of a first lien default and fully funds their current business plan through 2026. Shutterstock. For someone looking at online investment options, the choice is often between high-growth tech like Nvidia stock and speculative energy plays. Plug falls into the latter, but it's a speculative play with $3.15 billion in market cap and real-world infrastructure. If you are managing Fidelity IRAs or checking your Robinhood investments, you have to weigh the risk of further dilution against the potential of a massive turnaround. The short interest is currently sitting at around 25.5% of the float. That is an enormous amount of downward pressure that could turn into a springboard if the company reports even a slight profit in their next quarterly update. We've seen similar patterns in Apple stock during its darker days, though the scale is obviously different. The point is that sentiment can shift much faster than fundamentals, and right now the sentiment for Plug is so low that any piece of good news acts like a lightning bolt. Looking at the competitive landscape, they are leagues ahead of peers like Bloom Energy in terms of integrated infrastructure, yet the market is pricing them like they're a startup. This is the expectation versus reality gap that keeps the stock interesting. The market expects another year of disappointment, but the reality is a tripling of sales in their most critical product line and a management team that is finally cutting the fat. Whether you use the Fidelity mobile app to trade or prefer the advanced tools of the Interactive Brokers platform, the technicals are showing a stock that is deeply oversold on every long-term metric. The Interactive Brokers fees for shorting is also something to watch, as they have been fluctuating wildly, indicating that the easy money for the bears might be drying up. If you are using SoFi investing or have a Robinhood crypto and stock account, you've likely seen the headlines about NASA and PlugPower. They recently started their first liquid hydrogen contract for the space industry, which opens up an entirely new market. This isn't just about forklifts anymore. It's about high-stakes aerospace and massive data center builds that need off-grid power. The expectation is that hydrogen is too expensive for these applications, but the reality is that for a data center looking for 24/7 carbon-free power, there aren't many other options that work at scale. This is why the institutional activity remains a mix of skepticism and fear of missing out. As we wrap up the analysis, it's essential to look at the central insights. The expectation is a company failing to find its way, but the reality is a firm that has finally narrowed its focus. They have improved their margins by over 60 percentage points in a year. They've secured their funding through 2026, and they're replacing their leadership to focus on execution over expansion. The stock price of $2.20 reflects the scars of the past, not necessarily the potential of the future. The contrast between the negative market narrative and the positive operational milestones is at an all-time high. Whether you are using Fidelity brokerage account, Robinhood fractional shares, or an individual brokerage, the decision comes down to whether you believe the structural changes they've made are enough to overcome the massive debt and past mistakes. The authority in this space is earned through survival, and PlugPower is currently doing exactly that, surviving long enough to potentially thrive. Finance disclaimer: the information provided in this video is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investments involve risk, and past performance is not indicative of future results. Please conduct your own due diligence or consult with a certified financial professional before making any investment decisions. Don't forget to like, comment, and subscribe. If you found this breakdown helpful, please hit the like button, comment below with your thoughts on Plug's turnaround strategy, and subscribe to the channel with notifications turned on so you never miss a market update.